Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard. Why do you laugh so hard when I say that?
Before we start, I got a new haircut.
No, it looks good. What does everyone think out there?
Well, my staff told me that, how come your head looks bigger? I go, well, I have a big head? No, the hairline kind of going back. I go, okay. I'm going bald, and I got a big head.
That was Sarah, wasn't it? I was just saying. Did I say that out loud? / engineer. Hey, we have a new engineer today.
Yeah?
In training, Stephania.
Oh, she's right here. Now, Stephania's got a good story. She used to listen to our show years ago, for years, and now she's part of our staff, which is fantastic.
When she was in college.
Yeah, I know. Isn't that crazy?
That is a long time ago.
No, we're much older than you thought.
Yeah, right? We're just kidding. All right. We haven't really bagged on this on the show, and I heard a phrase that was used by a couple interviewees on my morning business show. My wife used it a couple times in the last week, so I thought I'd run some by you and see if you could. Oh, yeah, absolutely. Oh, okay. Right. And see if you had some phrases that we're tired of hearing that should just be retired. 24/7.
All right, got it.
That's amazing. Awesome. At the end of the day, right? You get tired of hearing that? How about air quotes? The guy that uses the air quotes?
How about the high five? The running high five at you all the time.
Well, it's knuckles now, isn't it?
High five.
Then you get the low five. Honestly,
like you're lying to you
every
normally?
other time was not the truth. So I'm going to unpack this. They start telling you something, and, well, let me unpack that for you. Instead of saying, let me just explain it. Just saying.
Just saying's another one.
But the one I've heard...
That's when they were trying to cut you down or something, or say something bad about you.
Just saying. But the one I've heard a lot this week, I think finally deserves to make the all-time list, is the experience. The guy from AT&T was talking about his 5G network and the phone experience that he's providing for his customers.
Phone experience?
The phone experience. The AT&T experience. Kind of like the McClure experience. Yeah. My wife helps set up board meetings for new part of her job description for multiple companies for Buckner. And she said, yes, we are taking over the board experience. So apparently everything is an experience. So we should have the McClure experience.
Well, with the Star here, they got the Lincoln experience. I thought it was a dealership for Lincolns, but no, they don't sell Lincolns.
What is the Lincoln experience?
It's just the experience. It's like a two-story thing in the Star.
Oh, you're talking about the dealership?
Yeah, it's not a dealership. They don't sell cars.
Oh, you just get to visit.
You get the experience.
Ah.
So I don't know what that means.
But when you start to hear something 4 or 5 times in a week, it's like, really? Well, there's another one. Really?
Thing I hated in the 90s was the paradigm shift. That was the worst thing I'd ever heard. They said, you don't need profits. You just need the internet. There's going to be more computers. That's when, at that time, General Motors was one of the largest companies in the world.
Yep.
And Yahoo was worth 5 times General Motors. Yahoo had 0 brick and mortar assets. Yep. Losses of $600 million a quarter or something.
Oh, and their PE was what?
It was negative. They were losing $600 million a quarter.
Right.
And I'm like, what? And they go, do you think there's going to be more computers next year? How about more internet? Because it's a paradigm shift. Everything's gone to this. And you know what saved Yahoo's is when they started buying brick and mortar. When all these people went back to old world, it's like the Googles and things like that. They started selling advertising. That's where it went.
Think outside the box.
Oh, yeah.
Synergy. Synergistic.
You got all these crazy things.
I know it. You can go on forever.
I don't think I say any of that stuff.
No?
I don't think so.
Really?
Nah, probably. Honestly?
Let me be honest with you. You do it all the time.
Oh, here's another one. No offense.
Yeah, that's right.
But you got a fat head.
And that's coming just before they are going to offend you. No offense intended, but
I really think you're a jerk. And
that's
you're
right.
What?
That's right. Anyway, I got to thinking about that. I heard experience. The AT&T experience, the Board experience, the McClure experience. Everything's an experience.
Oh, I'll tell you the experience I don't like is calling these people to fix your dang grill in your outdoor kitchen. Called them Friday. By Wednesday, one called back. 5 of them called. And they wanted, they said, well, I go, I need to fix it. You can go ahead and clean it while you're here. How much is that? $500 to clean the grill. Then they got a service charge. Oh, then they got to order the parts. They got to pay for the parts. I'm like, well, I'm not buying the grill. I just wanted it prepared. So now I took it all apart and I'm doing it myself, and I broke half of it.
Now you got to hire them again. They won't return your call. This time right now reminds me just before 2000. Remember when the drive-through people were making big money? Everyone was employed and everything was great before the big tech crash in 2000. Sure. Right now, I've had several clients tell me, like you with the barbecue. I've got another client that's looking for double wide for their lake property that they've got, Palm Harbor and all these. They won't return their calls.
You can't find people. They won't do small jobs,
now,
especially.
You know me. We were looking at doing something in the backyard, maybe a fireplace, a kitchen, something overlooking the lake. I called several. I won't mention the name. One did yours. They won't return. I had to call them 3 times. After the third time, I said, screw it.
No, that's only a $50,000 job. We're not even going to answer the phone for that one.
But we're at that time right now where it's hard to get people to come out and do something.
When we built this office at the Star, they said there were, at that time, 80,000 people short of skilled laborers. And so to do my duct work, it cost me $40,000. And I was like, well, the air conditioner's already in this particular building, right? Yeah. Well, we got to put the ducts in. I go, how much ducts am I getting it from the first floor?
Did you get copper ducts?
Like, what's going on? Just the duct work. And they go, we are putting a thermostat in your office. I didn't realize.
What was the quote you got when you just for toying with the idea of copper gutters?
$40,000, $50,000.
I know, it was like,
I'm like,
that was crazy.
Can you get some that look like? That's what I got.
Yeah, did you want
How
to
about look like copper? Well, that's only like $2,500. I'm like, sold.
Anyway, so
no, you can't do that kind of stuff. Remember, we developed this show decades ago. Had another person come in this week, and they called us 16 years ago.
Yeah.
And came in. I go, well, my show must be working as a great advertising tool since it took you 16 years to get in here. I go, that's not the record though. Another one was 20, and I go, okay, you've been listening to the show for 20 years. You're coming in now. He's now a good client, right? But he goes, I had to make sure you want a fly-by-night operation. I go, 20 years? He goes, and when I started the radio, we'd already been doing this for years.
Right.
He goes, yeah, I had to make sure. I was like, all right.
I had 2 people from 15 that called in 15, called back, said they were ready. And
I'm getting a whole bunch. I don't know what we did radio shows back in around 2000. And I think 2000, as you get older, I'm thinking that's a couple years ago. It's almost 20 years ago.
It was a long time ago.
But yeah, so they're calling. There's one thing, if you never had a customer complaint, which neither of us have ever had, you stick around. You stick around a lot. And that's what happens here, is we've been around a long time. Both of us been in this business over 30 years. We have more credentials than anybody I know, and no complaints.
The buzzword now is fiduciaries. You would think we would laugh about it. If you're dealing with somebody's money, their interest should come first, so fiduciary shouldn't even be an issue. But we are fiduciaries. A lot of people are not.
Right. We have to put your interests ahead of ours, which should be the
norm,
the standard, the norm. That's everywhere. Right. And remember, we do it differently. After the break, we're going to talk about how. Just an example of how we do an analysis, okay? The one thing I can't stand is a sales pitch. Don't get me wrong. I'm not ridiculous to know that we're not in sales. That almost everybody out there is in sales of some type,
Absolutely.
Right? If you're not sales, you're support. It's just the way it is. I go, but when you do it the right way, when you do such an in-depth analysis of someone's situation, that's when it becomes real. It's not, what you want is a retirement plan. You don't want a hope. And that's what 90% of the plans are. And what we'll do after the break is show you, remember, all of our plans, there's no cost, no obligation, no nothing. The worst that'll happen is you'll know exactly where you're at financially. If you're going to retire now or 20 years from now, you'll know where you're at. And then you can make appropriate changes or adjustments. And right now, if you do it before retirement, because I have this happens a lot. People have listened to our show for a long time. They like our advice. And they come to us, okay, I'm about to retire. If they could have come 5 years earlier, don't get me wrong, we can still help them, and we will. But any adjustments cost about 20, 30%, 60% less if you have to make an adjustment.
It's like a large boat. If you make course corrections along the way, they're minor. If you wait to the very end, you may have to change 45 degrees.
That's right. So that's what we try to do, but we'll show you after the break how to do that. Remember, if you have any financial questions, we're here to answer them. It's 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Remember, you can always go to our website, ilovemyretirement.com, and that's what we want. You're retired, you love your retirement. Remember, the biggest compliment I've ever got, and I get it quite a bit, is we've been with you 20 years. We've never worried about money once.
No, and
that's exactly
I can tell you, I've had several clients after they've been gone. Their kids have come and said, hey, you took such good care of our parents. We want you to handle ours as well. And that's a very big compliment.
Sure. Our number 972-715-2424. Yeah, there's new white papers and things on the website. There's videos. ilovemyretirement.com.
They say that's the second thing to go.
That's right. That's right. All right.
I finally got you back. Took 3 years, but I finally found the spot.
I've been waiting to sneak that in for a while.
I've been just waiting. I got it.
All right. Remember, there is a huge difference in people that do financial analysis on your thing. In other words, look at what you've got, and here's what you got. Now, I've seen some pretty decent ones.
Absolutely. And
I've seen some horrible ones. And obviously, there's probably 90% on the horrible scale, okay? But I've seen some we've seen one recently that was really pretty comprehensive. We really liked.
Yep.
It's a little different than other ones, but I liked it, okay? But most of them, they're not plans. All they do is take a snapshot of what you have, right? And then they put their managed program in there or whatever.
Based on assumptions.
Right? And then they give you some average numbers, average returns or this or that, right?
And as we like, there's a couple different types of retirements. There's the guaranteed and the non-guaranteed. Unfortunately, most of what you see is a non-guaranteed. And the reason is they're using usually high assumptions, 7%, 8%. Rate of return through the rest of your retirement. And I promise you, if you can sustain that rate of return, you will have no problem in retirement. My favorite type of plan, very similar to what we do and Victor's going to go into, is one that's both comprehensive but easy to understand. I mean, one that it's detailed but yet understandable. So many of what we've seen, and usually when you start out in this business, and we used it, if you remember 25 years ago, they'd use some sort of Monte Carlo scenario, and it shows you 1,000 different alternatives for what you're trying to do. Yeah, well, I'm trying to be kind. It almost looks like a solid piece of paper, but it is comprised of each different line. And you're trying to find what's the most probable outcome for what you're trying to do. But really, it's more confusing to new folks than comprehensive.
But the thing about it is there is a science behind it. The problem is until the market gives us something new, which I'll give you an example. Market for the last 100 years until 2000 averaged like 10% a year. The difference was there was a lot of it was dividends. Now dividends are less, all that. But even that being said, all dividends reinvested, everything, made about 10% a year. Now, since 2000, the market's made 4.4. It's changed. So now those Monte Carlo simulations might give you a 90% chance. Now they're down to a 60% chance because of what has happened.
Plus, a good percentage of the portfolios in safe fixed accounts, what have those numbers been in the last 10 years?
Very
Terrible.
low. That's
and
right.
That lowers your average, too.
When we did Monte Carlo simulations 20 years ago, like the likelihood of a portfolio exhaustion or whatever, they never assumed a money market would be under 2 or 3%. Never assumed a CD be under 4% or a bond under
30-year
6.
bond, yeah, it's something stupid.
Because that's why I've looked at one of the biggest firms in Dallas. I'm not going to mention who they are.
Oh, go ahead.
No, I can't.
All right, don't
All
do
right.
it.
But they're huge, and what they say is, okay, we ran an average market and a below average market just to be conservative, and then an above average market on this portfolio. The problem is, if you look at the average, what they're using, what do you think the average 10, 20-year bond is the last 100 years?
Yeah.
It's like 6 or 7%. What's a 10-year bond now? 3. Government bonds 2.6.
That's right.
They're not okay. So is below average that number?
And what
or
happens
higher?
And what happens every time the Fed tries to raise rates?
Right.
Everything craters.
And so you've got a deal in the market 10, which is made 4.46. And so what you have is when you look at their below average numbers, it might be using a 5% long-term bond, an 8% market, which is still 50% higher than it's actually returned. So this is not a plan to make 50% higher. That's a hope.
But what's confusing, it's justifiable numbers if they go back
That's
far
right.
enough. So
You
you
go
look
long
at it, you
enough.
go, oh, well, that makes sense. And it doesn't.
I don't care what happened in 1923, and neither should you. It has nothing to do with now. It's okay to look at long-term inflation rates or cost of living adjustments since 75, stuff like that. But when you're talking about trying to predict forwardly on the market, it does not work. None of it works. So you got to do a different approach, okay? And so that's what we do. Our first thing we do is we're going to stress test this portfolio. And we're not going to say if you make average market. So think about it. You got $2 million. It makes 10% a year. You're getting $200,000 a year. If your bills are 100, you're fine. Why would you even need anything in writing about that? You know it's fine. What if it doesn't? And that's our number one thing we do first is, all right, let's stress test this thing. Say, what do you think the worst case is? Well, you can use different numbers. Let's say it's 4%, 3%, 2%, 1%. What I like doing is trying to get it, what's the worst rolling 10-year period of a particular allocation. In other words, like equities. What's the worst equities ever done over 10 years? It's 0, actually. Okay, it made 0. It didn't lose any money, just made 0. So that's a decent number, but let's give it 2, because I'm pretty sure reasonably I could probably make 1 or 2 even in bad times, right? So let's do that. Okay, now let's look at it, just keeping it exactly the same as it is now. Am I eating cat food when I'm 80, or am I eating caviar? That's step 1. We'll go over step 2 when you come back for the break. Be sure and call us if you have any questions. Remember, there's no cost, no obligation for the most comprehensive retirement plan that I've seen. 972-715-2424. Again, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by 2 of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome. What we're trying to do today is show you what our no cost, no obligation retirement planning software can do, and our thoughts behind it, and how much better it is than other ones because of the things we talked about. Remember, we're not going to show you an average market. We're going to stress test it. You need to stress on the portfolio to see what happens if things don't go so well, okay? And so that's the first thing we do. We gather your information, put all your Social Security in there. We got to put inflation. If you don't count for inflation, I'm telling you, if you got $5,000 a month coming in now and that's your bills, it is impossible to have $5,000 a month 10, 20 years from now in bills if you just maintain the same lifestyle. It's impossible. There's no way your water bill is going down. Neither is your electric bill. I've told this story before, but my house in Plano I had for years. I had 100-watt bulbs in every single receptacle. I said, well, I'm no wimp. I don't want that 40-watt bulb. You can't even see from that thing, right? I wanted it to burn your eyes out if you got close to it. I've actually touched those things and melt your skin. Now, that's a light bulb. I never had a $200 bill. All right. Remember, I also didn't like the attics with the metal in them, the insulation, the metal stuff that keeps it all in, attic. I didn't have none of that. Never had a $200 bill. I've got my super energy efficient home now with all the stuff in the attic, there's fans. Also, every bulb is LED. Oh, my gosh, they're so low of everything. And I never had a $400 bill on the low side. So I'm paying, there's no way I'm using more electricity. Just like there's no way I'm using more water, but they're just charging you more for it. and that's exactly what they're going to do for everything. I just can't imagine. The electric company has decided to cut all of their kilowatt hour charges in half, and then next year we're going to cut it another 20%. Is that even possible?
Well, think about it. When we were kids and we lusted after Corvettes, they were $7,000. Now they're 70 to 120.
Right.
So I mean it's a real deal.
Oh yeah, I remember when I bought my first Mercedes. Boy, I thought I was something else. I was in my 20s. I was single. Oh, this is gonna be the greatest day in the world.
It was a 190. Come on.
It was like 37.
It wasn't a 550S.
It was $37,000, and I thought that was the most money anybody ever bought in a car in their life. Right?
I understand.
I'm like, oh, now. You get a nice Honda Accord, it's $30-something, right? Or 40.
That's right.
My wife bought an Acura, I think it's 50. It's just things go up. So you got to account for it. Also, did you ever think...
That's because you bought her dream car.
Yeah. When I paid $2,200 a month for my family's insurance. $2,200 a month. Did I ever imagine that 20 years ago? Did it ever come into my mind, I'm going to pay $2,200 a month for health insurance? Or when you go, if you go to the doctor, look at a bill one time, like the hospital bill. Remember I had day surgery. I was there for 3 hours, $16,000 just for the hospital part. That's not the anesthesiologist, the doctors, or anything else, just the hospital part.
That's a facility, right?
That stuff's gone up 7% a year. You better account for it. They say it can cost like $600,000-$700,000 a person by the time you're death. A retiree, one of their biggest concerns should be health cost.
And that's another thing. So there's some assumptions we make on the planning. There's some things that we need to know. And it's a short list. If you call us, we can walk you through it. It's really like 8 or 9 questions. It's not mad. At least to get us in the ballpark, and then we can audit it later. But I digress. The 2 things that are the hardest to project for in retirement. One is your medical expenses, because you don't know how healthy you're going to be. You can look at your genes and your family and you can get a good guesstimate, but things have changed. We're different. We've done different things to our bodies and they've probably done to their bodies, you need to come up with some number, right? So you got to guess on that. That's difficult. The other one is longevity, kind of the same thing. They kind of go hand in hand. You never know how long you're going to live. My grandfather lived to 99 in 10 months. I think Grandma was just a few months before 100. So their genes are good. Does that mean I'm going to make it to 100?
I'm sure you got the bad ones.
Yeah, could be. But that's also hard. So how many years do you plan for? How long does the money have to go? We talk to a lot of people, and when you go through the retirement plan, once you get to about 80 or so, they lose interest. Oh, I'm not going to live that long. Well, what if you do? It's important. Oh. Anyway, those are kind of hard things to plan for, but we need to get a number.
Right. I remember I used to make that day. I go, you got to plan for a long life, regardless of what your medical history is or whatever, unless you dying of cancer.
Plan
or something.
For 100, and if you do better than that, God bless you.
I had a guy come in my office, 60 years old, said I'm going to die at 70. There's no way nobody in my family's ever made past 70, so I want at least 10% a year out of this money. That's about $1 million.
And he's 85 now.
We didn't do anything, but
No.
I'll go. All right, we'll do that. I can sign you up right now. The only issue is, and you're okay with it. Nobody's ever lived. What if you lived to 81?
Yeah.
Just 1 year. I said retirement can be a good thing or a bad thing. But if you're completely broke, it could be real bad.
That's not fun.
And so they didn't do it, but you've got to plan for a long life. You've got to stress test it. And you've got to do all these things. We can actually adjust medical inflation to higher than other inflation. All right? And we can detail it down to that small of a detail. Call us at 972-715-2424. And like I said, take advantage of a no-cost, no-obligation. We can get you an information kit, whatever you like. Again, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
Welcome. Today we're talking about what a real retirement plan should look like and what we provide. Remember, you stress test it. You got to put inflation in there. You got to put cost of living adjustments. You got to put your Social Security numbers in there. All of those things. Okay, make sure. Okay, we're still okay here. Now, what if one of you dies? What if one of you unexpectedly or expectantly at normal life dies? Because what happens is, what do? You lose one of your Social Securities, right?
That's right.
The lowest one drops off. Am I going to be okay now? You've got to show that if both of you live forever, with inflation, with all these things. Now, if one of you dies, what happens next?
And bills drop, but they don't drop in half.
No, I haven't had that where they go, okay, it's going to be half the bills. They go, well, you're still paying the same electric bill. You might be a little less.
Taxes on the house are the same.
Everything's the same. Yep. I go, my number has been, honestly, with my experience, about 85% of expenses are still there if one goes. Now, here's a big one. Does your retirement plan do this? What if one of you goes to a long-term care facility or needs long-term care at the home? If my wife puts me, because she's a little younger than me, she puts me in a nursing home, I'm going to haunt her. Because hopefully I'll have 2 French nurses. I don't know why I
she's already trying to get you committed, isn't she?
So I'd have nurses come to your house. Well, what does that do? Now remember, you're not 55 at the time. You might be 80, right? Whatever, 85. How does that affect the other spouse? You need those numbers. Now also, what you're doing is people think sometimes they'll account for it a little bit, but they forget inflation. Those numbers are what, 5, 6, 7,000 a month right now for long-term care. I know people paying over 10 right now, over 12, but let's say 5, 6, 7. 20 years from now, say you're 60 and you're going 80. Is it going to be 5 or 6, 7,000 then? There's no way. Our software will show you, okay, let's put inflation on it, show what it really is. Right now, the numbers 20 years are going to be in the 14, 15,000 a month range. If it just goes up, say 4% a year,
yep.
That's all it takes to be $15,000 a month. And so, have you accounted for that? Has your plan even mentioned it? Or have they tried to say some ridiculously expensive long-term care policy when you haven't run the numbers to know if you even need it? That's what this does. So first, we stress test. Make sure we're not eating cat food with a stress test. What if one of you dies? Now what if one of you needs long-term care? So all of these steps have to go.
And be careful when you're shopping plans and you're talking to a couple different people, because we take the path. We have a tendency psychologically to take the path of least resistance. We'll do more to avoid pain, meaning having to make changes or go for a stress test, than we will to get pleasure, perhaps someone that shows you higher rates of return. So they base this, as we talked about, on a 6 or 7%. It looks better. You have to do less. It shows that you're good to 110. I want that plan.
That's right.
And that's not really what you want to do. You want a guaranteed retirement under the worst case. If we have good times, you'll make it. Right. But if it works, it's got to work under the worst case first.
We lose clients. Over the last 30 years, we have lost many clients. Many.
Using a smaller...
Because, that's right. Because, well, the other one looked like I was going to have 3 million more. I go, that's in their fake 10% a year you're going to make for the next 40 years.
That's right.
But
that's right.
This, no matter what, this is a sales business. It is. What's the easiest thing to sell? They don't have to change much. Hey, just stick with my managed program,
yep,
and you're going to be fine. Oh, you've done such a great job. What if the other one says, ooh, we really need to do stuff here? I'm like, well, the other guy said I was fine. Or the other girl said, all I got to do is do this pay this 1% management fee, and I'll be fine. Yep. They showed me all these numbers. That's not what you want. We will tell you the hard stuff. The reason we haven't had a complaint in 30-something years each is we'll tell you the hard stuff. We're going to tell you what won't work. We're going to say, all right, if things don't work, are you prepared? What if that market loses money? Are you going to be all right? And they'll say, well, no, our 4,000 years of experience with our 15 money managers or blah, blah, blah. That means nothing. I don't know one person back in 2000 that predicted the stock market will make under 5% a year for the next 20 years. Do you know one?
No.
Did you meet one prognosticator that said that was going to happen?
Nope.
It's just like somebody asked me, did anybody pick Donald Trump to win? Guy's the one I know.
That's
Most
right.
people, none of them. None of them said it. Not one of. They never said that. Never said the market's going to make that. Now, also look back. Did they ever tell you that money market CDs were going to pay about 1% for 10 years?
That's right.
No.
Was that in your plan 10 years ago?
I want to see the plan that had that in there
right.
10 or 20 years ago. That's why you have to put it in yours. You want a bulletproof retirement plan, not some fluff piece that just tells you what you want to hear.
And we can get into that in detail in the next segment. But one thing that we found after doing hundreds, thousands of plans and jostling numbers and adding and subtracting this and adding health care and looking at one person and two person is it is amazing if you get your income guaranteed to match or exceed your budget with inflation through your life period. It enhances your risky part of your portfolio. It helps your savings because you've got more cash than you do expenses. It is, if we could share any secret with you, if you can guarantee that income, regardless what you need with Social Security, pensions, you've got it, it's there, life becomes much easier.
Well, what you're talking about, we're talking about this whole segment, when we're talking about the financial aspects of retirement. We're going to stress that. Are you still okay? Once you find out you are okay, if you're not okay, first thing we're going to suggest, if you need $10,000 a month, get $10,000 a month going in your bank account every month. That will make the psychological aspect, because I'm telling you, no matter who you are, if you've been working for 40 years, like I've been working for a long time, right? The day that paycheck stops, the very day, and you see, even though you might have millions, and you know there's logically, I'm not going to run out of money. But as soon as it starts going down every single month, it will psychologically kill you. You're like, wait a minute. Now couple that with the market going down 15% like it did in December. Now tell me how you feel. If you had the money coming in, if you had $30,000 a month coming in, you wouldn't have thought that at all. Stay with us, folks. You got a break coming up. Remember, don't hesitate to call us. There's no cost or obligation to the best plan I've ever seen. 972-715-2424 or go to ilovemyretirement.com. Stay with us, folks. Listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome. This show we've been talking about how to get a proper retirement plan done. It's amazing to me, all these years they said, I've got that handle, Vic, thank you. But I still want to do something else with you. I go, you mind if I see it? It's not a retirement plan. It's a
hope.
No. I've seen it. It's a collection of 5 different American mutual funds, and they ran, the last 10 years on them or 20 years or something on them.
Right.
That's not a retirement plan. That's just a return scenario that you've had over the years. That doesn't tell you if one of you dies, what happens. If one of you goes to a nursing home, what happens, or needs nurse at your home. It doesn't stress test your portfolio. It doesn't do all of those kind of things. Remember that one of you dies early. It doesn't seem like a big deal, but losing one of those Social Securities can be a big deal because, let's say it started with only $2,000 a month. Well, you had cost of living adjustments of 2.5% a year to that for 20 years. It's $4,000 a month now. And that $4,000 a month is going away if one of you pass away. You got to know what happens there.
That's right.
You got to know, like right now, it might be $5,000 to $7,000 a month for long-term care if you need a nursing home or something. You got to know that it's going to be $14,000, $15,000 when you're 80. Can your portfolio withstand it?
And there's a lot of little nuances that you may not be aware of. I did a Social Security maximizer for a couple, and this couple, the gentleman had maxed out Social Security, maybe at least double what she had. Well, if he dies early, it's better for her to take her Social Security early and get those checks in, because when he's gone, what happens? She gets his. So taking it early at 62, she got a few years worth of Social Security instead of waiting to 70 and not getting any if she took it early. If he lives longer, then it makes more sense for her to wait. So there's little nuances depending on who gets what Social Security, life expectancies that we can adjust for you that you may not have thought of.
Remember, I hate sales pitches. It's all math. Everything we do is based on mathematics. If you do that, math never lies. Okay. You can shade numbers the way you want to. I get it if you're saying, I'm only going to show you this.
Statistics.
Right.
Kind of like the Tony Romo stuff you talk about.
If you ever see a return here, I just saw 2 of them the other day. These are talking about great managed program, whatever, and you'll see a weird date on there. Okay, this said from March of 2009 till this. I'm like, what? Why are they going?
The very low of the market.
It was actually like an August to a November. They have cherry picked the best possible thing they can find.
Yeah.
The ones you are real. Okay, I started in 2000. All right, or 20 years. Right, 10 years, 20 years, 2000. Anything gives these weird dates. If you know it's February right now and they're using August to January of a weird years. It's cherry pick. It's not real. Don't even pay attention to it.
Rolling 10-year periods are usually good.
Rolling 10-year periods are decent, right? Rolling 10-year periods where they use every positive entry and exit point,
yes.
Positive or negative, those are good. Okay? Also, you got to remember there's the sequence of returns risk. Let's say you like stocks. You're a stock. I love stocks. We've been doing stocks forever. I manage accounts at Fidelity. That's where we manage money. So what if you like stocks? Well, what if the market has a really good few years right when you start? Well, the odds are that portfolio will stay together and not exhaust pretty good if you have a first, say, 10 years. What if you have a bad 5 or 10 years? Well, your chance of portfolio exhaustion and portfolio failure increase exponentially. And so what you have to do is you got to think a little bit. All right, for the next years, I'm going to retire next year. What are the odds that I'm going to have a 4, 5, 10 good years or 4, 5, 10 bad years? And then you got to factor that in. Our software will show you that. Okay, it'll show you what happens if you've had a bunch of bad years. What if you have a bunch of good years? That's what you have to do, because I'm telling you, if the bad years happen, it's bad. Now, why would we, I think, even plan for that? Let's say I'm an optimist. The market's going to have 10 years in a row. You're going to retire next year, and you're thinking you're going to get another 10 years in a row.
It could be 20 years.
That's 20 up years in a row.
That'd be sweet.
It's more likely people retiring in the next 5 to 10 years, they're going to have a few down years when they start. You've got to account for that. Don't listen to anything that gives you a static return. If you do a static 8% return, it completely ignores the sequence of returns risk, which is real.
That's right.
Everybody should see that before. And then after all of that, now we've got this thing. This is still an analysis of what you have. Now we got to say, okay, what are solutions if there's some issues? Remember, you got to identify a problem. You can't just you can go to anybody, they're going to give you a sales pitch on their managed program. They're going to give you a sales pitch on their annuity, sales pitch on a life insurance policy. But they don't know you. They're not making a sales pitch based on what you need and your shortfalls or your good stuff, right? So once you do all that, that's when you get recommendations. All right, what if we do this? Remember, I do like a guaranteed income stream for my bills. Whatever my bills are, I want that coming in every month. I don't want to worry about having to spend down something or get a dividend that may or may not come, or an interest rate that might be higher or lower. Just give me the money.
Not guaranteed.
Now, with the rest of it, I like cash because I like liquidity, and I like the stock market. To be honest with you, I like the stock market. There's nothing wrong with the stock market once the bills are paid. You do not pay bills with the stock market. Anybody that tells you that is going on their own opinion that may or may not work. I don't want my retirement based on what somebody's opinion may or may not work. If the guy's retired 20 years earlier and I go broke, what do they care? I want to know what it is regardless.
It's
right?
highly likely they profit from that opinion.
Yeah, probably. But remember, there's no cost. There's no obligation for our Social Security Optimizer, for our Retirement Analyzer. And we could, like I said, it's very comprehensive. We can break down even inflation for individual types of commodities. All of those different things are in there. Call us at 972-715-2424. We got people here that can put that together for you, and that will actually explain it to you. 972-715-2424, or go to ilovemyretirement.com. I want to thank everybody for listening today. I'm Victor McClure for Guy Allard. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.